Hello, and welcome to the Monday Call. Today, Stefan and I are joined by Charlie Astwick, investment analyst here at NZ Funds. Charlie, you've been with NZ Funds a couple of years now, and you're part of the investment team focused on research and analysis. But your role is slightly different from the traditional analyst who is deep diving into company earnings. You spend a lot of your time on the macro side, thinking about how markets behave as a whole system. I think I remember when we first met because you were building a valuation model way over my head, and that was monitoring global markets that compare opportunities across different geographies. You've worked on do earnings really describe the price performance of a share? You've worked on the IPO market and what we can garner in terms of the information that an IPOs across different markets give us. Does it mean markets are over or undervalued? And so it's quite unique, and it really helps the portfolio managers and the CIO really focus on some of that more high level stuff, while the analysts throughout the rest of the team are focusing on that bottom up company research. So it's really fascinating, and sometimes I guess you can go down dead ends and find that there's no real, I guess, strong conclusions you can make from your research. But that's the whole point. Fast forward to today, and the research that you've completed, we call it IRIS, but the investment interest rate investment strategy uh, is a bit of a doozy. It's a fantastic piece of research. It's really helping in the market at the moment because different countries and geographies are going through different types of cutting cycles with their interest rates as from a central bank point of view. So why don't we start there? Can you talk us through at a high level what is IRIS, what is the interest rate investment strategy, and then Steph and I will delve into heaps of interesting, hopefully, questions around what that means for the portfolios.
Yeah, sounds great. So I'm quite a fortunate position whereby I have a huge passion for macro analysis. I love economics, so that's allowed me to really enjoy doing this sort of research. Uh, Ken Fisher writes in all his books that you're going to read 100 things in the news, whether that be that IPOs are going to lead to a strong market or perhaps a crash, whether it be that this interest rate cycle is going to lead to these outcomes. And he says that you can read this in the news, but unless you've done your own research to kind of back that up, it's largely invaluable. So that's kind of my role is a bit like a myth buster, is I try and see, we hear this, does it actually happen? So what we've gone and done for the iris is pretty early on when I started working here, we had the question of uh, how does listed property perform? We imagined that the cutting cycle would be a great time for listed property in New Zealand. As as you can imagine, interest rates are cutting. This is going to make more accessible to invest in property, and therefore we expected that to be reflected in the returns of the sector. Uh, However, that wasn't quite the case, and that's kind of where Iris kicked off. We began to go,
Why wasn't it a case where share price just didn't go up as they were heading?
yeah, it was compared to the market, it was quite upsetting as they were cutting. And we found out that actually the cut to hike cycle was far more prosperous for REITs and listed property. And that kind of made us go, okay, maybe some of these beliefs we had needed to be tested. And when you thought about it, we realized that actually the cut to hike made a lot more sense because you've got those low interest rates coupled with that real benefit of the economy's starting to look a bit stronger. And that's kind of why the cut to hike is, in our research, the strongest. So I'll start there.
Let's go through all those different four quadrants and talk about them one by one.
Yeah.
We can talk about where we're actually at.
So the cut to hike cycle, the first cycle, starts at the end of the final cut, and these are Reserve Bank cuts, and move until the first hike. This is a period in markets where we see really strong returns. That's as a result of the underlying fundamentals of a cut to hike cycle are we've come out of perhaps a recession or a period where we needed to expand the economy. So now we've got a strong economy with low interest rates, which means that a variety of sectors perform really well. consumer discretionary, as you'd imagine, spending increases. Sectors like that perform much stronger than they do in, say, a cutting cycle. Then the hiking cycle is kind of a difficult one. You've got that overheating in the economy. That's maybe where you start to see some more sturdy names begin to perform well. For example, telecommunications, as we're starting to, towards the end of that hiking cycle, see a slowdown in the economy, which obviously with the iris, because we've analyzed what sectors perform really strongly here, um, and we've been able to relate that to a variety of fundamentals, you learn that actually we can make the most of this, even though the market as a whole seems to be backtracking a wee bit, particularly from those highs of the cut to hike.
So you've got cut to hike, and then we've moved on to the hiking.
Hiking, yep.
And then I guess it's just the opposite from there, isn't it?
Yeah.
That final.
So you've got that inverse, the hike to cut. Um, Typically not your favorite period of the cycle. Obviously, the cutting begins because the economy is not doing too strongly, and that's reflected in equity markets. In the research, you can see that there's actually only a small handful of sectors which have strong performance at this time of the cycle.
And is that because, yes, interest rates are being cut, but they're coming from a high base? So, companies are paying the most interest they would on their debt. Consumers are not feeling flush because interest rates are high.
Yeah. So it's the cutting cycle is a huge process. It starts off with exactly like you say, borrowers are paying a lot in interest, which does take a burden on how able they feel to begin investing in the economy. They're already limited by their investments they have made. And then this has the flow on effect of actually the economy is just not feeling as strong as it did in those other sectors. And I think that's really what we've seen in New Zealand in this current cutting cycle is there hasn't been that confidence to go out and spend as consumers. Business owners aren't wanting to borrow money because those interest rates started off relatively high, not extortionately high, but high enough to make you question whether you wanted to take out a large loan. And additionally, we actually had some pretty weak growth in New Zealand. So all those things paired together, you got the beginning of a cutting cycle, which was quite worrisome for everybody, and that was really reflected in the early New Zealand markets.
So I might. So what you're saying is there's 4 stages in the cycle process.
Yep.
The quadrants, as James called them, and then within each of those stages, there are some sectors that perform much better at any point along the way than others. So there's, I guess, implicit in that, is it true that there are all sectors will perform well at different stages, or there are some sectors that perform well all the way through?
So there are a few sectors which do perform relatively strongly throughout all stages, but there's actually no sector which performs really, really strongly. There is one caveat, and that is technology in the US. It's something we've realized more recently with our research when testing the iris in action, is actually technology in the US doesn't seem to be very phased by what the interest rates are doing. It's performing incredibly strongly at the moment for the last 3 years, particularly with it being a really high growth industry. People aren't going to If people are going to invest at the moment, it looks like that's where it's going to be. So we've actually made a bit of a revision and decided that potentially technology should be decoupled from the interest rates, and we should start to look at that for more its fundamentals. But that doesn't seem to be the case for the other sectors. And backtesting, we've found that actually the strategy works really well.
I guess on that it kind of makes sense when you look at Nvidia's result last week, and they did, I think off the top of my head, 56 billion dollars US in the quarter, and they're forecasted to do 66 next quarter. What's with an interest rate at that earnings growth, with that amount of revenue generation? That's revenue, not earnings. With that amount of revenue growth, that's pretty phenomenal. And I guess at that point, maybe that goes to your earnings project you did earlier last year, I think it was, where actually in this case it's earnings and revenue that drive share price, not interest rates. And you're always going to have, I guess, exceptions, aren't you?
Yeah, 100%. And that's kind of why with the Iris, it's not about methodically just implementing it and walking away from portfolios. You still need to consider the hundreds of different things, such as earnings for NVIDIA. We saw with the earnings research that actually earnings do lead a strong share price and strong returns. And that is pretty much what we've seen with those big cap tech names over the last 2 to 3 years. They've produced good earnings. Most of the time they've actually exceeded what the market expects, and that actually exceeding earnings is far more significant than just having good earnings, because as I said, the market's forward looking, so it's largely priced in. But when you get that boost, like we've seen with names like NVIDIA and Palantir across the last 2 to 3 years, that's what seems to be more important in that sector. And that's why we've decided that the way we implement this is as a tool rather than just a put it in place, walk away.
And I guess that also these companies don't have debt, and so they're not as affected by it.
They benefit from it almost.
They do, yeah. They can, yeah. They've got it on the cash that they're earning a good interest rate from.
How with Iris? So it's sort of it's a structured way of thinking about different stages in the cycle, and we can talk to the quadrants more in depth in a second. But how does that compare with traditional investing approach to thinking about rates when you're doing analysis of a company or a sector? Is it different in that? How would you describe its differences?
Yeah, so typically the main way is that bottom up research, something here at NZ Funds we do, we're really passionate about, and we've got a really good base on how we should do that. And that really does focus on pretty much the company, and any sort of interest rate component that we consider is, well, okay, how much debt do they have on their book? Are they going to be able to pay that off? Obviously, is pretty important when analyzing an equity. So when we try and implement the two different mechanics of investing, it's really pairing them together. It's not going, we're not going to use the Iris. We're not going to use the bottom up research. So if we have a meeting on perhaps portfolio allocation, it will be, okay, we'll have a look at the Iris here. It looks like insurance names are going to do well in the Australian cut to hike cycle. So we go, okay, what insurance names look good from there? You might go, okay, Suncorp, for example, may look like a good equity to invest in. And when you have those two things coupling together, that works really well. That's not to say that we're going to go, Genesis looks like a really good business, or Meridian looks like a really good business. We're not going to invest in them at all because of the Iris. And that's, I think, the real value in being able to use this tool as well as other tools in harmony with our more traditional investment approach.
Okay, got it. So to paraphrase, you've got you do your bottom up, and you're digging into the nuances of each company and understanding how it fits in within the broader economic framework and its own opportunities and constraints. And then at the other level, you've got how you think about each of that particular company sits within a sector, within the broader framework of how the economy is likely to unfold.
Yes, 100%. I think at the end of the day, it may be a really strong portion of the interest rate cycle for a sector, but if the business you've got isn't going to succeed, it's still not going to perform as we would like. So there is, like you say, a huge value in being able to couple the two.
So I want to jump into how it's relevant right now for an NZ Funds client portfolio. And I've been on the road a lot over the past few weeks. As you can say, we sit next to each other, Charlie, and you've never seen me at my desk over the last month.
And you don't really sit next to each other,
So really, and we've been talking to clients around our, I guess, change in geographic exposure over this year, where we've perhaps broadened out from the US and increased our exposure to countries like New Zealand.
Yeah.
And perhaps you could focus on the New Zealand market specifically. When we think about the four quadrants, what are the different, so we've talked about sectors, but as a market as a whole, what are the return outcomes when you look through history of what each of those quadrants produce, because there are going to be some quadrants that are better for the market as a whole than others. And perhaps you can then conclude of why are we quite excited about New Zealand because of Iris. And Iris has been a big driver into why at the start of the year we did want to migrate those profits that we made in some of those US shares last year back into the New Zealand market this year.
Yeah, so the cutting cycle, which we currently feel we are in and we've been in since August last year, actually hosts relatively strong returns in New Zealand, an average of about 11% throughout that period, which is above the long run average of share market returns, which is really nice. However, there is a bit of a element of having to interpret that yourself. Is a cutting cycle can have very different fundamentals. This year we've had probably a slightly more traditional cutting cycle. It's been one where it's probably been prolonged longer than we expected. They typically last about 9 to 10 months on average. Started August last year. We're well beyond that.
Yeah, it's
in
been-
about
it's
the
been-
15th month.
It's been a long time, hasn't
So it's been pretty prolonged, and we
I
additionally
guess that was the call from at the start. We wanted rates the market wanted rates to be cut in May, and it was August this year when they, I don't mean they were already cutting them, but really wanted them to get on with it in May, and it actually was August, and there's why we've gone so long, I guess.
Yeah, it has been a long process. I think some really upsetting growth figures kind of around the middle of the year kind of sparked that to go on a bit longer, but that actually fills us with a little bit of faith about the next part of the cycle, the cut to hike, which on average has actually returned about 16%, and that's across about a year and 2 months or so. And we actually feel that may have moved into some of that benefit. We see sectors like the retirement sectors actually in the last 2 to 3 weeks. Returns have been as we expected in the cutting cycle, not very strong, but they've rallied 13 percentage points and are looking a lot stronger. And we think actually some fundamentals like that give us a bit of positive hope that that cut to hike cycle is going to be a strong cut to hike cycle for New Zealand. We're going to see strong returns because I think the New Zealand markets come from such a low level of sentiment towards the market. I think at the beginning of this year, we expected it to be a bit quicker, and that's why we kind of adjusted portfolios to give a bit more weight to New Zealand. But I think that we're in a strong position to capitalize on that with portfolios being adjusted for that cut to hike, which allows you to get some slightly lower prices for some strong equities for the cut to hike that didn't perform well in the cutting cycle, which is actually very beneficial for us.
So you've got this pent up return, I guess, in the sense that you didn't get it in the cutting cycle, which was, what did you say? What's the cutting cycle return on average?
About 11.
And we didn't get that.
No.
And so you got the 16% average in cut to hike plus the 11 that you should have got. This had all of us.
You owe me some return.
Yeah, exactly right. Yeah.
Yeah.
And so I guess that's where the theme comes from, doesn't it?
Yeah, 100%. So, and we're already starting to see that upturn. The financial sector was a sector we didn't expect to do well in the cutting cycle. It's actually performed really strongly. But we went back and we went, okay, why is this? Because it's important for a strategy like this to consider whether there are not errors, but areas where we need to improve the research. And we actually found that if it lasted its usual 9 to 10 months, that you would have had zero returns in the financial sector in New Zealand. So that goes back to my point to actually the New Zealand economy. We had that really deep kind of that low. We had the trial where we went, are we going to be able to get out of this? It's looking pretty slow. You'd walk down Queen Street and there was nobody. And I think we've kind
It's
of
that capitulation phase where, what was it? GDP was negative 0.9%, and everybody, apparently the whole country was moving to Australia, and it was like, that's it.
yeah, kind of.
We're still getting
Yeah.
But now it seems to be we've gone, okay, that's behind us and we can move forward. And I think we're in a stronger position than, say, the US for that. The US probably still has a few more cuts to go. They didn't have that traditional recession sort of shape that what you'd expect in the cutting cycle. And that means that they've been able to perform a bit stronger in the cutting cycle than you'd expect. However, like you say, we expect to be able to get some of that 11% on the cut to hike. it looks like maybe someone like the US has chewed up a bit of that. So that's why we feel that New Zealand is probably a market with some really great upside, and that's been reflected in portfolio allocation.
How Australia through this whole cycle process since COVID has been much slower to hike, and then they didn't hike as much, and they've been, I guess, the way that interest rate transmission is different in the Australian economy. How are they placed compared with New Zealand? Because often New Zealand and Australia, perhaps unjustifiably, are sort of lumped together as a market. Are they quite different from us at this point, or are they? Should we see it as the same?
I think, obviously, being brother countries, if you like, uh, there is that expectation that we're going to do really similar. That when Australia is booming, we're booming. Sadly, that doesn't seem to be the exact case. Actually, Australia probably hasn't. They haven't had a recession for a very long time. What they felt like was a pretty weak economy this year has been pretty strong compared to what we've seen in New Zealand. Therefore, they haven't had the same cutting outcomes that we've had. They're still at about a 3.6% interest rate from the RBA, which is right at about their neutral rate. So they're not really easing monetary policy, whereas we've eased quite a bit. And we've actually had very similar inflation outcomes. Obviously, a huge thing for the RBA and RBNZ to consider is the impact of inflation. Here, we've seen inflation at about that top of that range at 3%. Australia's last monthly indicator, they're at 3.5% with a much higher interest rate. So they truly haven't had the burden on the financial markets like we have. So it makes us really consider a few of those names that should have performed well in the cutting cycle haven't performed as well as they could have. Likewise, a few which were excluded have performed really strongly, which goes back to, I think, what we were saying before, where you have to really consider all the factors. When we were allocating, when we were doing portfolio allocations, we went, well, actually, Australian economy still looks pretty sturdy. It looks in a good shape. So we're not going to fully listen to the iris. We're going to go, actually, this will probably have some upside. And that's also the benefit of not going, you're excluded in the iris. We're not going to invest at all in, say, agriculture. That's not the case at all because we know the power of diversification and portfolios. So we've been able to manage the slightly more non-traditional cutting cycle that they've had in Australia. And that means looking forward that there's still, considering that inflation is so high, GDP growth seems fairly sturdy in Australia. Unemployment's pretty hard to get an idea of in Australia. There's some uncertainty as their unemployment is rising slightly. However, there's some really strong labor cost growth in Australia, which kind of contradicts that. So we think that they've probably either got one more cut, similar to what we expect to New Zealand, or to be honest, they may be in that cut to hike phase of the cycle, which is really exciting for us as investors in the Australian market. So while it's been really different, I think they will both be trending in a very similar direction and a good direction that should be.
And then it's interesting because I guess their market is driven so much by commodities. It's the lucky country that they have brown gold buried in places where no one wants to live and a very nice coastline where you can live.
Yeah.
But it commodities in this part of the cycle tend to do quite well because as interest rates have come off, commodity prices demand for commodities increase and prices go up and it helps Australia. And then you've got a China recovery. So there's all these other external factors. But suffice to say, the IRIS still says actually Australia is in quite a nice place to be solely because of where they are on the interest rate cycle. So it's sort of a double whammy.
Yeah, you kind of get the best of both worlds. I think that's a good way to put it. And that commodity base in Australia does often have implementations on iris outcomes, and that's because they're just so consistent. There's a huge demand for Australian commodities, and that kind of threw off, for example, the agriculture sector. Actually, the Aussie dollar's appreciated a wee bit since their first cut in February. However, the New Zealand dollar has depreciated quite significantly, and uh, while some may see that as a weakness, actually for Iris portfolio allocation, that's really good. That's what we want to see. As the interest rate comes down, we expect that the currency should depreciate a wee bit, and that's been really positive for New Zealand agriculture and exports. Agriculture since August last year, when we started cutting, has returned near the highs of 70%, and exports around about 50%, which are some pretty fantastic returns. And that is because New Zealand exports and agriculture have become relatively cheaper compared to foreign countries, with our interest rate just being that much lower.
And there's the other catalyst for the New Zealand market is the fact that those earnings from agriculture go apply back into the economy and create that earnings growth as well as the interest rate cycle. So it's again getting the best of both worlds here. I wanted to bring it back to the strategy on the client portfolios. One aspect was we've increased our allocation to New Zealand away from the US. The other aspect is worth mentioning is within the New Zealand and Australian portfolio, which is within the growth allocation, that has also been overweight Australia as well as having the clients overall have a higher allocation to that portfolio, but then within that portfolio, there's a overweight allocation to Australia because of exactly what you're saying.
Yeah, there's been obviously a recent top up in Australian futures for portfolios and those higher growth portfolios, and that is because we've realised that Australia, kind of towards this end of the cutting cycle, has backtracked a wee bit. However, that appears to us as a result of Iris and a variety of other research that we've seen that actually it's a really good time to start investing in Australia, and it most certainly justifies that overweight to the Australian market.
Within, I guess within the New Zealand Australian economies and this point in the cycle, what sectors are the ones that are drawing most your attention to, and how do you know? Because it feels like it's as you were saying before, there's other trade-offs like diversification and timing and so forth. So it's a thing of degrees. How do you think about moving between those sectors through time and increasing your exposure as the cycle unfolds?
Yeah, so as part of our research, obviously, end of cutting cycles and end of hiking cycles is really hard to work out because it's not like the RBNZ says in their final meeting, this is our final cut. We're not going to cut again.
That's it, guys. We're done. Off
Yeah.
to the races we go. So.
Which, while that would be really nice, we actually did some research to go, okay, what happens if we start adjusting portfolios a week after that final cut, 3 weeks after that final cut, and about a month after that final cut? And it worked out that actually there's not a huge hindrance to missing that by a week. You can fall off a wee bit because it's actually, like I say, it's not the interest rate per se, it's all the fundamentals behind that. So we have started positioning for the cut to hike already, and that involves us going and researching names that we think should perform strongly. And that's kind of the strategy we've implemented. You can see in our portfolios that there's a strong allocation to names like Ryman and Somerset because in the cut to hike, they just look to be doing really strongly. As people have a bit more wealth to go around, that's when these sectors perform their best, and they're coming off, as I mentioned before, some pretty low lows, and we see that as an awesome opportunity to begin investing in sectors like that, as well as property, which is our allocation to property and portfolios increased significantly over the last couple months. And that is as a result of us gearing up for this next part of the phase, which we're very excited about.
And this is twofold, isn't it? It's in the growth portfolios, but also it's in the inflation portfolios where you've got the allocations to New Zealand, or half the inflation portfolios is New Zealand, Australia, but also you've got some of those sectors like property poised to do quite well because of that.
Yeah, the inflation sector is one that is get up to do well. Actually, inflation obviously in the cut to hike cycle does start to ramp up, and that means the revenues for some big infrastructure names and industrial names and property names are going to be pretty strong. We've seen main freight already beginning to have some strong earnings, which are indicative of what we hope to see for the rest of infrastructure throughout this next stage of the cycle. So it's not just the iris isn't only benefiting that really high growth sort of portfolios, but actually the inflation portfolios will 100% see the iris in action, and they should reap the same benefit.
How, if you were, I guess, if you were an advisor and you were trying to explain it to an investing client, what would be the key, I guess, points you would want to really tease out?
Yeah, so I think the main point is that the fundamentals of the economy have a huge impact on not just how consumers and investors are willing to invest, but also how different industries benefit from earnings. And it's all a relative game. Obviously, we have scarce amounts of capital to invest. So it's not saying that infrastructure is not going to have good earnings in a phase of the cycle. It's instead going, well, there's going to be better earnings uh, potentially somewhere else. And that's kind of the power of Irish. So what I would say is it's not a game of purely winners and losers. It's a game of who maybe wins a wee bit more. So that would be probably the first point. Second point is that you really have to take a look back. And I think that's probably what this research is all about, being from top down, is that it's about looking back. And I think for advisors, when explaining it to clients, it becomes really natural when you think about it afterwards, when preparing updates on the iris. That's my approach. Once all the numbers are done, we have a graph that shows the winners, well, not the winners, but the higher performers and the
Benefactors.
lower performers
Yeah.
in each phase of the cycle. And when you step back from that, it becomes abundantly clear. And I think to us that's a really positive sign. I think when you have to try and manipulate something or interpret it in a very complex manner, that kind of goes to say that perhaps there's not really anything there.
Yeah.
But when something becomes obvious, and that means it's easy to explain to clients, that gives us some pretty strong conviction that there's a real power behind it.
So back testing, there's not a lot of overfitting. It's quite a simple model. You just, and then you can see it. How did you go through the process of back testing it? Because that can be difficult, right?
Yes. So what we did was we kind of confirmed these are going to be the benefactors in this phase of the cycle, and we kept those fixed. And then we went all the way back to a variety of different points based on the different markets, but we went way back for about between 5 and 6 interest rate cycles.
Oh.
So first of all, we went, okay, winners, losers here, and we kind of worked out who our higher performers were. Then we went, okay, how does this work as an investment strategy? Because to just know this is not going to benefit clients, but actually to be able to go and interpret it and use it as a portfolio allocation tool is what's important. And that's what we did. We went back and we actually tracked it and compared it to those long-term returns. Obviously, like anything in capital markets, you may have a cutting cycle which actually these allocations didn't perform as well. But when you look at the long-term charts, it's almost eye-opening how different those returns end up being with the strategy in place, because you're just removing a little bit of the downside from a certain sector and replacing it with a slightly more overweight upside of another sector. And in the long term, that may be maybe a couple percent. But when you compound that, it works out to be really good for portfolios. I have to say, I took a very traditional approach, and there's probably about 100 spreadsheets that have been used, and that may be more the way my mind goes, okay, I'll do this here and that there. So it may look very complicated on a spreadsheet, but actually doing it simply, it was purely a matter of looking at return, looking at the sector return, looking at the interest rates, and it's a pretty easy game from there.
As a side note, Charlie, how much did you use Excel in your spreadsheets, and how much did you use AI to help you with the analysis?
So I think for the early parts of it and actually creating the iris, that started very much just a lot of Excel, a lot of numbers, a lot of Excel spreadsheets that take probably 20 minutes to open. But in the later times, as I was saying, when you take that step back, AI was a really useful tool. I think it's useful for us as investors, but it's also really useful for perhaps clients when they look at something like the iris. They can go, okay, the facts say that retirement's going to do really well here. And instead of having to think about that yourself, you can ask your friend ChatGPT and say, hey, buddy, why is this happening? There's got to be a reason. And he'll say, that's a great question. Yeah, of course. And they'll say, that's an excellent question.
Do you know you have that? I have that argument. So many people have different views if it's the guy or a girl. It's one of the most disagreed with topic of AI.
Have you asked it?
No, I'll go Tassie, whatever you want to know. It's confirmation. But I think this is interesting though, because I guess this is a really good example that, and it goes to why we are taking AI as something that's incredibly exciting, and we have to be wary of it, but not scared of it, because it hasn't. You need to have the background and the knowledge and the, dare I say it, brains and capability to do the analysis. But what it's enabled you to do once it's been done is really stretch and mold and change and work through the model that you've built to see what happens in different scenarios. And that's the power of AI, which was much harder to do if you're trying to do all that part of it on spreadsheets.
Yeah, and I think it's also really beneficial to, I think often people can, like you say, AI might have confirmation bias for you, but I think actually we more have the confirmation bias.
Absolutely.
And I think AI is a really good.
Like the property one that you said, you expect
You expect it, and then you realize no. I think AI is great as being like the. Obviously, you're not next to me on the desk. Say, oh, it replaces you, and I can ask and say, can you challenge me on this? And it will, and it allows you to build up your insight, and actually makes you a much more critical thinker, and that's really important when building out something like the iris. You can't just fall into the trap of this says this, done.
Tell me why I'm wrong.
Yeah, 100%. And
Which does a great job of in my case.
yeah, and luckily for the iris, it seemed to be very agreeable, and it agreed with the ideas that we've built out here of the fundamentals as to why this all happens.
Yep.
Okay, I got another question, which is, so at each point in the cycle, there are some sectors that perform better than others, and there's rhymes between periods where you get, and you can infer from that over future periods you expect to see similar benefactors and, I guess, detractors. Are there any sectors that really surprised you in how they performed at the different stages? And are there any sectors that are more marginal? Like in one period, this one you did better, and then the next one it didn't, and it was hard to kind of comprehend why that was.
Yeah, there are a couple sectors that were a bit shocking. I have to say, probably the biggest shock to me was consumer discretionary, the cutting cycle.
So what's a consumer discretionary?
So consumer discretionary, some of those big names like Hallensteins, Briscoes, kind of those ones that are fueled by consumers getting out and spending some money, which is something we typically don't see in the cutting cycle with that recession risk and just the general downflow in the economy. However, I think that kind of made us reconsider the fact that a cutting cycle isn't just one stagnant period. It goes through the full flow. You go from those peak interest rates where everything's looking a little bit glum, and it starts to go down. So I think consumer discretionary, initially, I was like, this cannot be the case. But again, when you take that step back, you realize this is accurate. The numbers are pretty convincing on it. And as a result, it's something we allocate in the portfolio. There are some which were probably slightly.
Was that the same in the US on that?
Yep, consumer discretionary.
Because often in New Zealand, it's because these are smaller liquid companies, but actually happening in the US as well.
Yes, it's happened in the US and Australia, and that's kind of one of the benefits of doing it across the three markets. I go back to Ken Fisher in his books always says it can be a coincidence if you see it in one place, and that's why he went and did the other two markets in the same amount of detail, because you go and realize, wow, this is actually something that's happening, and it has something to do with the fundamentals.
How just with consumer discretionaries and ChatGPT perhaps, is it a function of the fact that as consumers have less money because they're spending it on their mortgages and so forth, and the margins of those companies tend to be pretty slim, that's where the profits go, and then as earnings, share price follows earnings. Is that broadly it, or is there some other factor that you kind of observed that is driving it globally?
I think it's really big on, like I was saying with that earnings research that have also done, is markets are very forward looking. I think we start to go, like I've said, we've done with our portfolios, is you start to position for the future. And we know that maybe consumer discretionary's had a slightly rougher period. However, we're very trusting. Humans behave, very advanced, but also very simply. As soon as those rates are lower, we start to feel a little bit wealthier, and we go and, for the most part, try and spend that money. New Zealanders have a very high propensity to consume, so a lot of that money goes straight to consumption as opposed to um, other directions of spending.
I actually I brushed off the cobwebs of my Hallenstein's Glasson's model that I built in 2003 or something, and read the result that they had. It was about 4 or 5 weeks ago now, and it's exactly what you say. What I found, why I did it, and what's really interesting is that they reported their year-end result, and it was always going to be terrible in terms of the back history. Actually, Australia was not too bad, what we've talked about, but the New Zealand. It turns out no men buy suits during a recession at Hallenstein's is pretty much the case. I think again, don't quote me on these, but I think Hallenstein's profitability was down 35% or something like that, which you'd expect given the environment. But you read the rest of the outlooks, the rest of the statement, and it talks about Glasson's not so much better. Women buy a few more cardigans in a recession than men buying suit at Hallenstein's, but then at the it's a 2-page, I guess, announcement. At the very bottom of the announcement of the Hallenstein's Glasson's result, they said, New Zealand remains difficult, but in the first 10 weeks of trading this financial year, it's slightly less bad than expected. And that's kind of all you want. And that's probably of that feeling of, actually, the suit's getting a bit dreary and I feel a bit wealthier.
Yeah.
And they've probably seen it in a slight pickup. But because the shares were so cheap,
Yeah, it's been a great opportunity for us. And I think that goes back to what you're saying and what we said before about the fundamentals of the equity are still really important. We see Hallenstein's Glasson's as a great business, a business that not only will continue to do well in the cut to hike, but because of those underlying fundamentals, and are going to go and buy suits from them. And some ladies are going to go and buy some cardigans from them. Perhaps maybe not cardigans as we head into the summer months, but that is the benefit of pairing the iris with the two. And I think it's really interesting to see how it's acting in the real world, and as we do see earnings come through, to be able to interpret it and not just look at it from that plain perspective, and maybe not see the financial statement as being hopeful for the sake of being hopeful, but actually because our research suggests that it's going to do well. I think that's a really valuable outcome of the iris.
So I interrupted before about consumer discretionaries and getting. What were the other sectors? You were kind of you talked about consumer discretionaries being a shock as how impactful, I guess the cycle was, but there were others that were more marginal, I believe.
Yeah, there are a few that kind of sneak their way in, I think would be the way to put it. And also some that sneak their way up. Healthcare and the cut to hike is one that tends to just slightly underperform the market. And bear in mind, in the cut to hike, that's a pretty high barrier to entry, a 16% return. However, that's where we sometimes do have to consider the larger impact of the fundamentals. Where healthcare is actually being upsetting in the cutting cycle, particularly in the US. And
I love the emotion.
Yeah. Oh, sympathetic. Yeah. I'm feeling it.
but it truly is. It's meant to be really good in the cutting, and the cut to hike we expect less. And like I say, because that's so marginal, it means we go that little extra step further and go, because it's marginal, do we think there's still a really good opportunity there? Because obviously, in some past cut to hikes, it's done really well and it's been weaker in others. And we think because it's been pretty weak over the last year, and that's we anticipated it to be a lot stronger. In the election year of the election cycle, it's expected to be much worse, particularly with the uncertainty in the US around healthcare as we have parties come into presidency and leave. And I think that's kind of lasted a wee bit into this first year of the presidency in the US.
It's probably a good reflection, isn't it, of the, we talk a lot about you have to ignore the stand-up press conferences that Trump, like and will load them, does, because it just creates a lot of noise and volatility that's kind of irrelevant. Healthcare is slightly different, isn't it? Because it could be a direct effect on policy around healthcare stocks.
Yes, yeah, I think the other ones, and I think that's exactly what we've seen, the other ones have been able to perform strongly because it is, like you say, a bit of noise. However, healthcare is one of those ones where the US has often been quite divided in terms of where funds are allocated, and there's been talk around removing some funds towards away from the healthcare industry, and there's also been the maintenance of some funds. So investors kind of haven't really known what to do. However, we think as we move into some slightly more certain times surrounding healthcare, it might do better, and that's why looking at the marginal difference between the averages during that cycle is something we take seriously and we really consider.
Fantastic. Okay. Did you have any other questions, James?
No, I wanted to, just to wrap things up. This is a super interesting piece of research. We said we'd talk for 35 minutes. We've talked for much longer than that because I think it's fascinating for me and hopefully for those of you that are still listening. Is there anything else on the horizon around what you're looking at? What's next on the Charlie Astwick research agenda?
Well, currently working on I think a piece that's quite interesting for clients at the moment, something that you hear about in the news 24/7 at the moment, and that is bubbles. That's where my research is currently focused. Doing a lot of the fundamentals now, reading a lot of research about actually what do we need to see in a bubble, and then from there going into looking at what does a bubble actually look like. There's been a lot of bubbles, and bubbles don't just happen in equity markets. As we know, they happen in housing markets, but they also, the original bubble was in the tulip market, and it's a result of that euphoric mindset. So while we're still in the early days, I think we're potentially not at that bubble stage that you may be hearing in the news. However, it's really interesting to see where we are progressing in terms of that peak of a bubble.
Interesting. Or we look forward to you coming back on the Monday call and talking about that.
Yeah, long-term stock, short tulips. Okay, I just wanted to say my little what I've really I thought really helpful here, Charlie, is I guess for clients and advisors alike, what you're saying is from a top-down approach, trying to stack the odds of high-quality decisions from a macro perspective in our research, and then obviously we've got a whole team of analysts underneath who are looking at each company individually, in which we're directing capital to. So it's both ends of, I guess, the research spectrum working in tandem to optimize the decision-making process.
Yes, 100%. And I think that's what's going to deliver the most informed portfolio decisions.
Brilliant. Thank you very much.
Thank you.
Charlie, thanks for joining us. First time presenter, so really appreciate your insights, and feels like you did pretty well, so you'll have to come back. So yeah, so careful what you wish for. So we look forward to the next piece that comes out and chatting through that.
Sounds great.
But before then, thanks very much.
Thank you.
Thanks.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.